Okay, so now this is another question, problem 2.3a. And in this question, we're supposed to calculate the balances. So they have given us the opening balances for assets, liability, and owner's equity. And then they have also given us information about what are the sub accounts in assets. So we have cash, we have land, building, and office equipment. We have two types of liabilities, notes payable and accounts payable. And then in owner's equity, we just have capital stock. So part A says list the December 31st balances of assets, liability, and owner's equity in tabular form as shown. So you're simply supposed to copy this over there. That is what the part A is asking you to do. So we are going to copy all of this over here. We are done with part A. Now record the effects of each of the 5 transactions in the format illustrated in Exhibit 2-11. So simply what we're supposed to do, we're supposed to write the plus minus amount and then calculate the new balances after each transaction. So the first one is sold capital stock to owners for 35,000. So if you're going to sell capital stock to owners, that means that owners are going to purchase those shares from the company. And when they're going to purchase those shares, obviously they're going to pay. So they're going to pay $35,000 to the company. The company is going to receive cash. So the first impact is that you're going to get 35,000 in cash. And this cash is coming from your capital stock. So it's going to increase your owner's equity. And there is no effect on the other accounts. So the new balances will be 37,000 plus 35,000 gives you 72,000. In the remaining accounts, there was no transaction. So the same balances will be brought forward. And capital stock has increased from 200,000 to 235,000. Now, the next one, second one is purchased land and a small office building for a total price of 90,000, of which 35,000 was the value of land and 55,000 was the value of building. So we're going to use these separate amounts. We know that we have purchased land and an office building. The amount for land is 35,000. So we're going to increase land by 35,000. So this is land. We're going to increase this by 35,000 and office building is going to increase by 55,000. Then it says paid 22,500 in cash. So we know that some of the amount was paid in cash. So cash is going to go out of the business. This is negative. So negative we're going to show by brackets. And then it says, and signed a note payable for the remaining 67,500. So for the remaining amount, we only paid 22,500 in the form of cash. And for the remaining amount, we took out a loan. And the amount for the loan was, 67,500. And nothing happened in the remaining accounts. So the new balances will be again, so we're going to notice over here that we had two types of liabilities, notes payable and account payable. We will use this note payable account only when the question specifically says note payable. Okay, apart from that, you're not supposed to use notes payable. Then third, we have bought several computer systems on credit for 9,500 30-day open account. So you bought computer systems on credits. It means you did not pay for them on cash, which means you bought them on the basis of loan. It's a liability. So your computer is in office equipment. That is going to increase and your account payable is going to increase. Now you can see the difference. What is the difference between account payable and note payable? Account payable is when you buy something and you do not pay for it. Okay. Whereas note payable is a type of certificate and usually interest is paid on notes payable. However, both are yes types of loan. So now we'll calculate our balances once again. So these are our new balances. Office equipment has increased and you can see that your account payable has also increased. Fourth is obtained a loan from Capital Bank in the account of 20,000 and signed a note payable. So now it says note payable, so we'll use a note payable. and you have obtained a loan, which means that the business has received cash. So your cash has increased and your notes payable has increased. And these will be your new balances. Fifth is paid 28,250 account payable due as of December 31st. So you paid account payable. Account payable is a liability and paid means that you paid in terms of cash. This is going to reduce your cash amount. So cash is going out of the business and that cash is being used to pay off your liability of this much. And these are your final account balances.